Welcome to Market Call. John Zechner is our guest today, chairman and founder of J. Zechner Associates. He's taking your questions on North American large cap stocks. Here's the number, 1-855-326-6266. Or you can email us at marketcall@bnnbloomberg.ca. John, great to see you.
Andy.
So you've been telling your clients you have a range for equities, and I'm bringing you down to the low end of that.
Yeah, absolutely. That's what we've been doing. I'm getting more cautious, particularly lately. It's just been too much bullishness. I'm looking at sentiment, valuation, other things. But I think people are underestimating the economic risks from the tariff regime. Because I look at it and I think, suddenly 15% is the new level versus 10. And, I think Trump feels somewhat empowered after, the Iran-Israel thing and the big budget bill and getting, some of these deals, even though they didn't do the 90 deals in 90 days like they've been talking about. But, they're going to stick to the tariffs. They like the tariff. He likes the revenue coming in. I think they need it from a deficit basis. Now, what I don't think the markets have really adjusted to yet is just that what the impact these tariffs are going to be. I think you're starting to see it in some corporate earnings report. I mean, GM outlined it clearly the other day. You saw, CN Rail, Texas Instruments, a lot of the companies like that. But, I think more importantly, you're moving from an average tariff rate of, 1.5% to 2% to, what is it, 14.50? I don't know where the number ends up, and it's changing constantly. Yep. And this is going to change corporate behavior. Companies need some sort of surety going forward, a consistency of what the environment's going to be like. Until they have that, they're not going to do capital spending. They're not going to hire people to the same degree, and I think you're going to start to see that. So I got economic concerns, valuation concerns. I mean, the market's now 26 times trailing earnings, right back to the high, and that's for earnings that are only growing at a 5% rate. Like, yeah, maybe it'll get better than this, but that's pretty, pretty high on historical basis. And sentiment. I mean, sentiment got really beat up into the April lows, which made it a great buying opportunity. Now, I look at all the surveys, the AAII, like the Investors Intelligence, the Bank of America survey came out the other day. They're all right back to, lowest cash, highest bullish indicator. So, valuations and sentiment alone do not create market tops necessarily, but what they can do is accelerate the downside once you do start to move like that. So, and that's what we saw in April. So, but I think more importantly, what you're going to start to see is just more trepidation, from companies, cut down on some consumer spending. We're starting to see it in the employment numbers, starting to see it in the housing numbers. So, from our point of view, I mean, we're at the low end. I've increased our bond weighting because I think from the tariffs between inflation and growth, which is the bigger risk, I think it's a bigger risk to growth. So I think ultimately, Trump will get his ways. I think rates will go lower, but they'll go lower for the wrong reason because economic data is slowing down pretty significantly. So in that environment, I got to get more defensive. We could take the equities to the lower end. We've increased our long bond portfolio. I'm getting more sort of taking the bait out of the portfolio, getting more defensive in the holdings. The only thing we're sticking with is tech, because they've proven themselves. You just see the AI spend will continue. You saw it in the Alphabet numbers last night, and you see, that will continue on. So that remains a good sector. So, in a nutshell, in a big nutshell, that's why we're sort of a little more cautious right now, and probably talk that way throughout the show. So,
John, it's great having you here. Thanks very much. Our guest on Market Call, John Zechner of J. Zechner Associates. North American large caps are the topic. 1-855-326-6266. Let's kick off here with an email from Bert. Your opinion on Laurentian Bank?
You know what, Andy? And Bert, it's still an avoid as far as I'm concerned. I mean, it has a lower valuation than the rest of the banking sector, although that has narrowed somewhat. They haven't delivered on the earnings. But to me, the bigger issue was 2 years or 3 years, whenever it was, when they effectively put themselves up for sale for the corporate. They were looking for, potential buyers within the Canadian market. And there's no expansion opportunities in Canadian banking. I mean, Canadian Western Bank was probably one of the last ones to go. And the majors want to do acquisitions. And I just thought was a layup for, Bank of Nova Scotia, somebody to get more domestic exposure. And I thought, okay, all these guys who know the industry really well went and kicked the tires and did the whole thing, and nobody stepped up and bought it. And to me, that was the biggest indication there's something wrong here. So, we've avoided it all along, and certainly the fact that it's dropped since then, it's still not, in my mind, a buy-in here.
Yeah, it was interesting. Yeah, when as you say, it's hard to grow without acquisitions, and nobody bit.
Nobody bit. Yeah. Why not?
Let's head to Victoria. Chris, go ahead, please.
Oh, good morning, Andy and John. Thank you so much for taking my call.
Pleasure.
John, I'm wondering if CN Rail is something that you wouldn't avoid at these lowered prices. I'm a longer-term investor, 5+ year time horizon, and I see it as a good blue chip, solid, moated company. Thanks for taking my call.
Yeah, you know what? I'm with you on that one. We have not owned the rails. I was really concerned. The multiples have been into the low 20s for growth that I saw somewhat at risk economically, but with this recent move down in CN Rail, I was sort of looking at it. It's probably like 17 times forward earnings. That's not bad. I think people are getting overly worried about some of the short-term problems they dealt with in terms of risk from tariffs, risk, economic risk. I think when the big Jansen mine comes in, the one the BHP bought in Potash mine, they'll get the east-west deliveries on that. So I almost think there's more risk on the north-south basis than there is more on the east-west, which is CN obviously is more tied to movements to the west coast and other things like that with increasing energy infrastructure. So down here at this valuation, we haven't owned it in a long time. I've been buying it in the last, on yesterday's weakness, we started picking away, and I'm fine with it down here. So yeah, I'm with you on a long-term basis. I think it's okay, even though it's had a tough week and it's seen a lot of downgrades, that's for sure. But I'd rather buy into that kind of weakness than chase things that have really been running hard and are, trading at peak multiples.
John in London, Ontario, go ahead, please.
Thanks, Andy. Hello, John.
Hello.
John, I sense a little bearishness today from you, but I'm still looking for the Trump darlings, the AI stocks, I guess Mag 7. Tesla did surprisingly well despite missing, until today, that is. Google did very well. Now, which is the next Mag 7 stock that's going to weather the storm? Does it start with an A or does it start with an M? Thanks very much, John.
You know what? I probably go back to the A because there are more A's in there, so I got a 3 out of 7 shot. That's pretty good. But Alphabet should play a little bit of catch up here. I mean, you're right. The numbers were really good. Everybody is worried about searches and clicks, and you looked at it. I mean, oh my God, YouTube. What are they? $10 billion in ad revenues, almost $10 billion for the quarter. They paid $1 billion in total to buy the thing, whatever it was, 10 years ago. I mean, it's just Waymo. I think it's great, the Android operating system. They get these assets they haven't even monetized yet. And on top of it, yeah, search is at risk. And I don't disagree with that, but I think the multiple more than reflects it. And more than that, people are going to migrate more to the AI plays. And on that one, I may do a Google search. I'm just as likely to do a Gemini search, go to Gemini and ask a question. So I think it is more when all of these guys start to monetize their AI investments. And I think that is, probably the next step. I want to see what Meta, Facebook does with the next iteration of Llama, whether they make it more closed source and open source. I mean, both Meta and Alphabet, made their bones on advertising revenue, so they're not going to, give away an open or leave an open system like that they can't monetize to any degree. So I think, that's coming next. So I think Alphabet benefits from that, and for an A, you get Apple as well. I don't. I'm not really enthralled with Apple at these levels. Valuation is still high. I like Amazon still too. I think you look what they're doing on a cloud basis. But yeah, if I had to pick one of those, I'd say of the next one in the Mag 7, I would go with Alphabet in here for at least a trade.
That's interesting.
Catch up. Yeah.
Alphabet up only 2% this year, whereas the Mag 7 as a whole up around 7%.
Trading below a market multiple. The only one of the Mag 7 below a market multiple, yeah.
Yeah, it's interesting with YouTube. Yesterday evening, we wanted to catch some high European culture, so we watched Eurovision songs from this year and last year, and you go to YouTube for that kind of thing.
I go down the YouTube rabbit hole all the time. And it draws you in. And plus, all the kids. I mean, so many are trying to become, want to be a YouTube star, but the models for paying these guys, for monetizing that for themselves is growing, and the clicks are growing. And you look at it, I think the viewership is just. Almost is just behind Netflix at this point on a streaming basis. So it's a completely under-monetized and underappreciated asset, I think, within Alphabet.
Let's go to Edmonton. Arden is on the line. Fire ahead, Arden, please.
John, as a beleaguered holder of BCE, is there any hope for this stock, or should I dump it and move on?
BCE.
No, BCE, the owner of this network. I got to throw that one in.
Thank you.
You know what? I'd stick with it at this point. I mean, stick around for our top picks at the end of the show. They're not one, but it's certainly in that same Billy. I think you've seen the worst news now in the telecom sector. I mean, Freedom Mobile coming in as a fourth player, and everybody worried. And the changes you saw, obviously, in immigration was a real headwind for all of the telecom stocks. Because let's face it, I mean, that's the only way you grow subscribers, because there's no penetration. Everybody, who do you know that doesn't have a cell phone? Unless you go further down in age or something like that. So BCE, they have their own issues and their own problems within that. But I think paying down the dividend, selling off their stake in MLSE have helped. And so down at these levels, no, I would not sell it down here again. And at the very worst, what's the dividend yield is probably still 5.5%, 6+%. So you get paid to wait at a low valuation. I think the sector has been so decimated over the past 2 to 3 years. I just think there's opportunities there, and I think you've seen the worst news that sort of led to this downturn for all the players.
Yeah, sure enough, a yield of about 5.2%. Yeah. And as John says, BCE, the parent of BNN Bloomberg. We're going to be back with John Zechner. He's taking your questions on North American large caps. We're back. John Zechner taking your questions on North American large caps. Let's go to Huntsville, Ontario, which just played host to the premiers and the Prime Minister. Frank, go ahead, please.
Yeah, great. Thank you for taking my question. I wanted to buy TD stock here at this level, but I just feel as if it's run up so much that maybe I should wait till it sells off. So I'd like to know whether you think at this level TD is a good buy, and if TD is not a good buy, I was looking at CIBC or Royal Bank. So I'll hang up and listen to your answer. Thank you.
And Frank, before you go, if you don't mind me asking, with all the politicians in town, did you see lots of black limos driving around? Was there a lot of impact?
You have no idea how many black limos and police were here. Unbelievable. We had the G10, I think, back in 2010. Right, it wasn't as bad as that, but it was unbelievable. Yeah.
They like to travel in style. Yeah. Thanks very much, Frank. TD Bank, John.
At TD Bank, we've taken it off recently, and Frank, I sort of I agree with where you're coming from on this one, because it was massively underpriced relative to the rest because of the risk of growth going forward. But once you realize the amount of excess capital they had, you realize what the final charges were going to be in the U.S. for the anti-money laundering charges came up against them. It was like $4 billion, whatever, but they still had lots of excess capital. Then you started to play a little catch-up in valuations, and I looked at it. We had done a switch between CIBC and TD Bank near the late last year, and CIBC was in the low 90s, and TD was like almost $20 lower. Next thing I know, TD has closed the gap and was trading above CIBC, so we switched back the other way, and we still own CIBC. CIBC valuation is getting a little bit stretched as well. So if I were to I would agree with you that I think Royal is now not as big a premium to the rest of the group, and they're delivering best on some of the earnings. Scotia really looks interesting to me here. KeyBank had some pretty good numbers. That acquisition, even though it didn't look too good right off the bat of U.S. Regional, could end up being a pretty good acquisition for them. And obviously, they're focusing more on the domestic. I think you've already taken the worst hits on their Latin American exposure. So if I were to add one name on the Canadian banks right now, I'd put Scotia at the top of the list.
And TD, sorry, getting a bit...
We're out of it right now.
Oh, okay.
We've reduced it almost, in almost all our accounts. Yeah, no, it's had a great relative return, and I'm sure we'll look at it again, but it's, it's still got some headwinds. It's still got no potential growth in the U.S., and that's not going to change in the near term. And obviously they're restricted in Canada, so, and they recapitalized, but, where's the growth going to come from going forward?
Sam is calling from Toronto. Go ahead, Sam, please.
Hi, I want your opinion about CVS, iShares Silver Bullion ETF. The gold price has gone up quite a bit, but the silver hasn't. Do you think the silver has a catch-up to do? I would appreciate your opinion. Thank you. Bye.
Okay, the silver has been doing well lately.
It's been doing better, yeah. But you know what? I would agree with that move for playing the commodity, and especially for silver. I would play the commodity directly as opposed to gold or playing the stocks. Traditionally, I mean, there used to be the ratio way back when of gold to silver. It would run around 40 to 50 times or something like that. What is it? What is it today? It's
well, it went to 80 times because gold was so inflated. It has come back. I don't have the ratio right now.
But I think relative to gold, it's somewhat undervalued, and it's actually got more of a commercial use, obviously, than gold has. And I think it's a good way. I still like the precious metal. I mean, you're not seeing silver being bought by central banks to the same degree you've seen with gold, which I still think is the biggest positive for the gold price. But I think in terms of silver, a good way to play it is play it directly on the commodity. Sometimes that makes more sense. I'm doing that in uranium right now, where the stocks have, just run too far, and I switched from, Cameco, which I sold recently, and I've gone to the Sprott, the physical trust, which is the direct holder of uranium. Sometimes it's better to play the commodity directly. Sometimes the stocks are much cheaper play.
Sure. Yeah, we can see silver's done quite a bit of catch-up there over the past few months. Thanks very much for that question. Let's head to Windsor, Ontario. Mike wants to know about a Mag 7 stock.
Would you be a buyer of Amazon at these levels for a long-term hold? Thank you.
Thank you.
Yeah, absolutely. They're clear of one of the major three players in cloud. The Amazon Web Service continue to develop it. They're a good player. Prime, Amazon Prime, the video is doing quite well when you look at the valuation of Netflix and how it's built into Disney. So they're developing their own production capabilities there. And I just think the basic Amazon delivery business is it's a bit of a loss leader, but it's still such a draw. And I think it's still a massive threat to the rest of retail. So they got a lot of legs to stand on in this one. They're generating free cash flow. The valuation used to be sort of in nosebleed territory. It's come down substantially. So I think there's a lot of growth going forward. And like you say, if Mike, if you're a long-term player, put it away. This is, we're asking about Mag 7 stocks to start with an A. Alphabet and Amazon. Put them away right now. I think Alphabet more probably at the catch up, but I think Amazon still looks great on a longer-term basis.
And we're expecting Amazon numbers actually a week from now after the market. Thanks for the question. Anne in Scarborough, Ontario. Fire ahead, please. Not hearing Anne. Intact Financial is the question.
We don't own it right now. I mean, it's delivered. It's been a great acquisition story. I just, I'm not playing the insurance side as much right now. You know what? I'm curious about these things down the road. We're way off from this. What's autonomous driving going to be doing to insurance rates and insurance payouts? I guess theoretically it should be very positive for them because in a sense, it costs a lot. These things are supposed to have far fewer accidents than humans. So, it's something that's not immediately in our face, but I sort of down the road want to look at it. In the meantime, these guys have done a phenomenal job of consolidating the industry and being a primary growth, and it's sort of the only such insurance play in Canada. So it's, it's an area that probably can be a cornerstone of any financial part of your portfolio, but on a valuation basis, we don't own it right now.
Okay. When we come back, we're going to check out John's past picks. He did pretty well on a space-related stock. That's ahead. John was on our show June 28th of last year. His first idea was MDA Space, and this one up something like threefold. Nice call there, John.
Yeah, it's an interesting story. This is the old McDonnell Detweiler, which is, can build space components for years and years. The Canadarm, everybody knows very well. Back in, I think, 2018, they then bought a company called Digital Globe, which is more assimilating like the software aspect, because they had gotten into the building of satellites for these LEO, low Earth orbit satellite systems. They started building these, and then they wanted to assimilate the information, and Digital Globe sort of put the software together. So at that point, they renamed Maxar, which, and then, but people were a little bit worried about, the debt they'd taken on to buy Digital Globe, even though it made sense. So what they did then is they decided to spin out sort of the nuts and bolts building of the satellite business. They sold it to private equity, and they kept on going. McDonnell Detweiler became Maxar, and then ultimately Maxar got bought out and by private equity. And then at that point, I guess, private equity decided, okay, there's a gap in the Canadian market for space companies, so they spun out this nuts and bolts business that it had been, the building of satellites, and the MDA. So it came back to the market. And we bought initially within the mid-teens, and then people were worried about the debt, even though they had a great growth profile going forward. And then the stock sunk to like $6 or something like that, and it was very worried. Then about a year and a half ago, they really, even though they had a great growth profile, Telesat was building this looking at his Lightspeed contract for a great generation, a new orbit of LEO, low Earth orbit satellites. But they couldn't really get the funding to do it. The costs were too high. I guess MDA demonstrated to them how using MDA's own satellites, their technology, and launching abilities could take the cost down so much that Lightspeed was able to get the financing because the cost of the project had dropped so much. When they did that, they gave MDA Space a contract, and then it's just gone higher since then. So we still own it. It's no longer undiscovered and unfollowed or anything like that, but it is, funny story on the side, it was 50-year anniversary of me graduating from high school. So I got together with a bunch of my high school buddies. We went out for drinks and all of that to celebrate the 50 years. And when the bill came, the one guy grabbed it. He says, "No, I want to thank you for Maxar and MDA Space and all of that." And I said, well, these are guys I went to high school with, which really they knew me back in the day, so I thought they'd have no respect for my ability at all. And if anyone from the OSC is watching, no, guys, we all threw our money on the table, so no way, it wasn't allowed to pay for that one.
We're a bit tight for time. Capital Power, the investors very interested in electricity generators these days.
Yeah, no, this has done extremely well. It got whacked really hard from the low 60s into the high 40s on the DeepSeek news, like no one's going to build a data center again, but what they're doing in Alberta with data centers is fantastic. And I think these guys at the natural gas-fired generation can do very well on providing this. And then they did a big acquisition earlier this year in the PJM, sort of that the eastern market in the U.S., and they just repriced. They did a new contract for electrical power for the next year at a massive increase in price. So they did this acquisition at the right time, financed at I think around $50, and the stock's now returned almost to where it was prior to the DeepSeek news. So it's a great story, electricity generation for data centers. And I think Alberta is making themselves a powerhouse there, and makes a ton of sense.
And then finally, Torex Gold. Let's see how this one did, because it's certainly climbed over the period. That's a double.
Yeah, and that you've met these guys before. That's another interesting story. They had the Morales gold property. Yeah. This was trading ridiculously cheap. Gold was $2,400. Stock was trading probably about 3 times cash flow, less than 50% of net asset value, but for a good reason, because they're more on the Morales property. This El Limon gold was running out. The pit was sort of finishing, and so you never get a premium for that, as you know. However, at the south end of the property, they had another new pit, the Media Luna, which they wanted to sort of use to replace this. Now, as you know, Andy, in these companies never bring these things in on time and budget. They brought it on time, on budget. They're not going to lose a step. They'll still have north of 400,000 ounces of production this year as they move, from the El Limon to the Media Luna. At the same time, these open pits, they've gone underground at both deposits, and they're finding great extensions. So I think it's taken the reserves into sort of like 2038 at low. And on top of that, the periphery is different into the underground. It's 70% gold, probably 30% copper, which is a nice mix going forward as well. So, I mean, yeah, they've done it on all counts. So it's not as much of a discount as it was, but we still own it, so like it. It's probably trading at, 5 times operating cash flow and below net asset value, which is still a big discount to the seniors.
We got to take a break. We'll be back with John Zechner taking your questions on North American large caps. We've got Bill in Toronto on the line. Bill, go ahead, please.
Hi there. Thank you for taking my call. My question is on Berkshire Hathaway. We know Mr. Buffett loves holding cash, and he's sitting on a pile of it right now. The stock has actually dropped about 12% since May, and it hasn't participated in any of this rally. It's bounced, and it's moving its way up a bit now. Would you be a buyer of this long-term, whether a TFSA or an RSP account? And especially, would you buy it in the CDR Canadian hedge? Thank you very much. I'll hang up and listen to your call.
Thanks.
Yeah, you know what? I would not be a buyer in here. I don't know. The Buffett premium is disappearing. And I mean, and clearly you've seen it, and you realize how much of a Buffett premium there was in this stock for a long period of time. Sitting on a lot of cash in this environment, it depends what they do with the cash. That's sort of a bigger risk right now. What do you want to pay? What's your return on cash? It's not really that great. The size is a bit of an issue for them. Insurance operation has never been the moneymaker for them, so you're not buying it for that necessarily. So it's really, these ancillary investments, and I don't know where they're going with them, what they're going to buy next, and you've got additional risk because people aren't sure with the, the new management and everything like that. So I don't know. It's not enough to entice me to say that this is, I would buy it necessarily even for the long term here.
We've got Harry in St. John's. Go ahead, Harry, please.
Yeah, hi there. I have a question for you on TELUS. Not looking for facts, really just looking for your opinion. If you look at a 10-year chart, the stock price today is really more or less where it was 10 years ago, so not much of any growth. After the bottom in the spring of 2020, the COVID bottom, it did have a nice rise for 2 years, went up to about 34, and then from the spring of 2022, it's been steadily down back to around 22 or so. My question is, do you see upside potential that TELUS, in your opinion, can climb back up to the upper 20s? Do you see it as a growth stock? And second part of the question is, the dividend is pretty high. It's well over 7% or 7.5% in that range. Do you think the dividend is safe?
Thanks. I should have said St. John you're in, Harry. Carry on. Tell us, please.
Yeah, the dividend is safe on TELUS. I don't see any risk. I mean, BCE, it's a whole different story from when BCE cut their dividend. Telecom stocks have all been under pressure, tremendous pressure for the past couple of years, which is so, performance over 10 years is always a point in time. They did well early in the pandemic, but then gave up a lot of those gains. TELUS did better, obviously, than BCE and Rogers and even Quebecor because they had more ancillary businesses. I think they did a little better, and they did better within their own markets, and obviously didn't have cable risk and things like that. That was a bit more of a hurt, but I am more positive on this sector going forward. And I realize people like TELUS probably liked it more within the industry, and that's why I get the premium valuation. I prefer to play the laggards a bit. We own all the names in the sector right now, but TELUS is probably the least overweight that I have of them.
Okay, we have Michael in Montreal. Go ahead, please.
Hi, Andy. Hi, John. John, would it be possible to have your opinion on Lightspeed as for a long-term or short-term hold? And if you're not a fan of it anymore, would you recommend maybe Toast? Thank you very much.
Yeah, you know what? We were buying it recently. I think this stock got down as low as $12 not that long ago. Obviously, on some of the delays they have had and some of the obviously they tried for a corporate restructuring. Nothing has happened there, and then they've obviously done some customer switches. They've gone to a different product where they focus more on sort of the higher end and a smaller customer base as well. So that's taking some time to develop. On the other side, you got a tech company trading at basically 2 times revenue. They're starting to generate operating cash flow. So it's a very cheap valuation. They're buying back a ton of stock lately. I mean, because they have a lot of excess cash on the balance sheet. That makes sense. So yeah, maybe nobody stepped up to buy this thing. It's not delivering like Toast is, obviously, in terms of the growth going forward. But I think they've got a strong product offering, and just on valuation alone, I think we still own it. To me, it's worth at least a trade from the low values it got to, and it's within the tech sector. It's a good fit in the portfolio.
Okay. Thanks very much for that question. Laurie is in Thunder Bay, Ontario. Go ahead, Laurie, please.
Hi. Yes, hello. And whether or not at the price is that today.
Home Depot. Sorry,
Correct.
Laurie. Home Depot. Carry on. Yep.
Yeah. Is it a good price today, or should I just leave that one alone? Thank you very much.
Thank
Bye-bye.
you.
Yeah, I'm not. The price stock's come down a long way, so it's cheaper than it's been. It's probably still a good long-term buy just because of their market positioning, their dominance, and ultimately housing will come back. I think that housing is in a bit of a downturn, a slowdown right now. I think consumers are going to go through some difficulties, particularly in the U.S. What I talked about earlier for the tariff risks. So we don't really have anything in sort of the retail consumer side right now. So I can't advocate saying you've got to buy it now, but it's certainly on a valuation basis, not at the sky-high multiple it was. I just think housing is still going to have difficulties in the U.S. given where rates are, where mortgage rates as they're coming up. You're facing higher rollovers, both Canada and the U.S. So I think the housing market is going to remain under a bit of a cloud.
We got to take a break. John Zechner is taking your questions on North American large caps. Alan is calling from Scarborough, Ontario. Go ahead, Alan, please.
Hi there. Your thoughts on Sun Life has been a bit of a pullback, still has a good dividend. Mm-hmm. Give me your opinion on it. Is it a buy? Thank you.
Thank you.
If you own it, I'd hang on to it at this point. I mean, when you look at it, the structure of the yield curve is somewhat favorable to them because you've sort of got a bit more normalization of the curve now with short-term rates dropping the way they have and longer-term rates staying a little bit higher here in the U.S. So that obviously helps them. Valuation is fine. I mean, it's at the low end. It's below the banks, and they've delivered on the earnings in the last couple of quarters. So it's a good long-term hold. It's not an exciting play or anything like that, but you're getting a decent yield at the same time as you're paying a cheap valuation. So, but not much growth.
Yeah, I guess Asia is a possible growth avenue for them.
Yeah, Manulife sort of put a stake in there and done a far better job of expanding into Asia. I haven't really seen, the Sun Life has really much of a play there right now, but, they could.
Okay. Alan, thanks for that question. Richard in Winnipeg, go ahead, please.
Hi, I'd bought in Disney, actually 1,000 shares at $90 a while ago. Now I was told back then it'd probably cap off at 140, but I see it's around the 120, 122. It used to pay a dividends, I believe. It's not paying dividends anymore. Is it time to sell it or still a hold? And what is better to own in your portfolio, mutual funds or stocks? 2 questions.
Yeah, I didn't catch a lot on stocks or bonds in the portfolio right now. You'd definitely be balanced. I mean, we probably have moved towards more bonds recently because I think rates are falling, and I'm a little worried about stocks. But generally, when you talk about Disney, I have a hard time with Disney. Like right now, I'm sort of mixed on it. We owned it, and we've sold it recently as well. On the positive side, I think they're doing exceptionally well in the streaming business. They're really sort of coming into right behind Netflix because they got such a great library and such a great branding. I worry about the parks ultimately because I think there's going to be consumer slowdown. I think you're going to get a global backlash against the U.S. to some degree. Could work with the Disney parks. Like in the end, this has probably been the pre-ultimate growth story in the U.S. over the past 6 decades, so it's hard to sort of bet against it necessarily, and they continue to brand and cross-sell better than anybody out there because, they come out with a product, they'll have a movie, they'll have a game, they'll make it a ride at the park, they integrate it so well. Plus, they got a great sports franchise as well. So they've got a lot going. I just worry in short term that the big driver for Disney is the parks. And I just worry, consumers generally, and maybe a bit of a backlash against the U.S., given, the international parks, that, whether their earnings can deliver over the next couple of quarters. So that would make me a little hesitant for now. But as a long-term play, it's still a great stock.
Now, they did hold the dividend during the pandemic. I guess that was because the parks were in such trouble. But they have resumed it since. Yeah. They resumed it in 2023.
Yeah, they generate healthy earnings, and they got decent cash flow, and the balance sheet's in fine shape. So no reason not to pay a dividend. So.
Okay, yield only about 0.8%. Thanks for that question. Chris and Hamilton, go ahead, please.
Good afternoon, gentlemen. Thank you for taking my call.
Pleasure.
I'd like John's view on Whitecap. It seems to have been doing quite well lately. I'm not sure why, and if John holds it, would he consider taking some profits now?
We don't hold it right now. I don't own any producers right now. We've gone totally out of the oil producers and focus more on the pipeline. I want companies that are more volume sensitive as opposed to price sensitive. Now, having said that, Whitecap's having a good day today. If I were to rank oil stocks, I would put Whitecap right at the top right now because I think, quite honestly, their buy of Crescent Point or Varen, whatever it was at the end, was exceptionally well timed, and I think they got a great asset at a great price. And you're starting to see that in some of the other drilling results they've had in the prior quarter. What Varen was sort of heading to in terms of growth profile, and that's Whitecap got that at a decent price. They're incorporating it. I just have a problem with oil stocks in the near term because I just see, you've got lots of supply coming on, and the OPEC Plus is going to sort of put more onto the market at the same time and concerned with demand. I think ultimately, oil prices will crack $60 again and maybe lower, and I think that's a risk for the sector. So.
Okay. We have an email from Stuart. Can you give us your insight into Atkins Rail East?
Yeah, we lightened on it a little bit recently. We still own it, and it's been a great stock. And obviously, they've had a huge move just based on what they do in terms of engineering for the nuclear expansion, which you're seeing globally. And these guys are a prime player in that. So it's been fantastic. I mean, Cameco has done well, with their Westinghouse acquisition for the same reason. And we're seeing a massive expansion of nuclear capabilities on a global basis. And these guys have great engineering. Plus, I mean, as they moved away from the old long-term fixed price contracts that made SNC Lavalin. They've moved on as more of a pure engineering firm. They're generating a higher multiple off their existing earnings as well. So it's a good story on that basis. It's just had a big, pretty good run, and we've really lightened up to a large degree across the board. So I'm not buying it at these levels, but we're holding still a position in the portfolio.
Laurie has sent us an email. Could I get your forecast for Meta? We're back to the Mag 7.
Yeah, the valuation discount that it had relative to the group has somewhat disappeared because of the strong moves the stock's had in the past while. So I'd take Alphabet on that basis, but it's a similar story. And I want to see what they do with Llama. If they move Llama, their AI model, more from it is completely open source, probably the most open source of any of ChatGPT or any of them right now. They sort of move it to more of a closed model. How they do with the advertising, so pay attention to what the earnings do. We own it. We own it in the portfolio. Continue to. Haven't added it to it recently. We haven't sort of bought it since the April sell-off. But it's a good core holding. Like I'm talking about Amazon and Alphabet. Within that Mag 7, those would be the three names that we continue to hang on to. NVIDIA, we're sort of more closer to an exit point on that one, and I don't own, Apple. I certainly don't own Tesla.
It's interesting. Apple and Tesla are the two losers among the Mag 7 stocks this year. Just remind us why you're a bit cautious on Apple.
Well, Apple, because it's just, I still think the hardware is a little bit more risk, and the valuation multiple is too high. So I just think, I can get similar growth elsewhere, and I don't know that they're really at AI anywhere close to it. Tesla, I mean, Andy, we don't have enough time to get into Tesla. Like, how it even gets into these things, it's like Tesla's a cult stock. Like, people believe it. If you judge this thing as a normal company, as an auto company or anything else, it'll be a couple $100 lower. I mean, look at the numbers. They're losing market share blah, 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 the margins are coming down. People believe in autonomous. People believe in the AI and what these guys are going to do with robotics, and they're paying for that today. We're not.
We're tight for time. Tyler sent an email. Give us your thoughts on Canadian pipelines in the next couple of years, specifically Enbridge.
I like them. I like all of the pipeline plays. Enbridge actually has done very well. A good dividend yield. I think energy infrastructure is a huge area of spending focus for Canada over the next number of years, and these guys are the prime beneficiaries.
Okay, we've got to take a break. We're going to get John's top picks right after this. Join us tomorrow on Market Call. Brian Madden will be on the show. He's Chief Investment Officer at First Avenue Investment Council, and he'll be taking your questions on North American equities. And if you ever miss Market Call, it's extremely unlikely, about as likely as the universe turning itself inside out. But if you happen to, check out our daily podcast. It's on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to John's top picks. First off, let's have a look at Rogers. People worried about the debt load post the show acquisition.
Yeah, and I sort of teased it throughout the show as what we thought about, why I like the telecom sector. I mean, it's underperformed dramatically for the past couple of years. People, obviously, the immigration changes in Canada have slowed growth, and as we said before, I mean, that's the only way you get growth in telecom is because, who doesn't have a cell phone at this point? So, that they've passed the worst of that. And then, obviously, in addition, the fourth player with Quebecor coming in with Freedom Mobile has put pressure down. And I'm starting to see those pressures be mitigated a little bit. Now, Rogers, obviously, as you mentioned, they had the Shaw acquisition, which added massive debt at the same time, and that was a problem. So people have really punished the stock along the way. And I look at it now, the valuation is as low as we've seen it, probably about 6.5 times the enterprise value to operating cash flow. We're seeing the bottom. I think in terms of cash flow, the growth still is starting to improve again. The free cash flow is starting to increase, and they're going to pay down the debt. And they're starting to monetize assets as well. They've done a deal with private equity for some of the back end communications equipment. Satellite towers, other things like that. They can monetize that. And the sports franchises. I mean, that is the biggest thing I think that has been underappreciated. Well, maybe less underappreciated. People are talking about it more. But with the buy of MLSE that they've got, and the fact that they own the Blue Jays, I was looking at them the other day, you compared them to some of the major sports franchises in the world, and they're sort of right around the top 10. And then you look at the value of some of these. I mean, the most recent acquisition, the LA Lakers, $10 billion for that. So you look at what they have in MLAC, with the Leafs, and all the assets there. The Toronto Blue Jays, which again, a national franchise, doing extremely well. The Rogers Centre and other things. You get a lot of value there. At the same time, you're generating free cash flow, low valuation, dividend yields. So all of that, we're not getting it right at the lows, but you're getting it after a big period of underperformance. So I like it.
B2 Gold is your next idea. What draws you there?
Well, it's almost like I talked about Torex earlier. When you look at gold stocks, I like gold stocks generally. I like the industry. I think, gold at least maintains these levels from central bank buying. I think the stocks are undervalued. I think B2 Gold in particular has been sort of underappreciated in the market for a good reason. Everyone was worried about the geopolitical risk. I mean, their biggest mine, Fekola, in Mali, is, that's over 500,000 of their million ounces in production. I mean, look what happened with Barrick over there. Sure, they've got an agreement, with the government, but that may not, doesn't really, people don't take that to mean too much necessarily.
And it's a military junta, and the Russian mercenaries are in there.
And the same thing, you got the Otjikoto mine in Namibia, say that 3 times fast, but that, that one people are worried about as well. So there's been this big geopolitical risk. They had a property in Nicaragua as well that was run down. But you look at it going forward, I mean, some of the growth they're coming now, the Gramalote project in Colombia is coming on. Yeah.
Oh, Gramalote is Colombia, I'm sorry.
I mean, and the Philippines as well coming on. Philippines is operating. And then the Goose project just came on earlier this year in Nunavut, in Canada. So you're removing that risk. Stocks trading at about 4 times operating cash flow, a discount to net asset value. And you still got the Mali risk there and in West Africa. But, it's going to be less of an impact going forward. And, already, I think, taking that out of the price. So you put that in. And then Clive John Johnson has been a great operator. So yeah, this one looks like a good risk-reward basis, to catch up to the group and liking the group in general still.
Yeah, that Namibia mine, they've been cutting jobs there and they're phasing a downscaling at that mine.
Yeah, it's not really in the future production numbers at all.
Right. And then your final idea, Pembina Pipeline.
Yeah, I talked about energy infrastructure in Canada. It looks to me like, one of the great areas to invest in. And we talked about, before, things like data centers and expansion there are great. But for Canada, we're going to look to go on an east-west basis to move product, natural gas. Pembina fits that very well, gas processing. They've been under pressure in the past year because of the tolling on the Alliance pipeline. And, people are worried about that. I think that's more than factored in. You're getting, 5.5% dividend yield. You're getting the lowest valuation of the group with more potential for growth. I don't know whether Trans Mountain gets spun out at a point. It might. These guys would probably look at buying into a piece of that as well. So, like I say, energy infrastructure in general looks good. We like all the names, but Pembina sticks out as sort of the most undervalued. Probably the better potential for growth, decent dividend yield. So put all of that together, I think it's a good story.
A yield of north of 5%.
Yeah.
And I mean, the enormous, and now apparently the provinces are arguing over whether pipelines can be built or not.
Well, they're going to be friendlier towards us. I mean, let's face it. I mean, Canada has realized, we going to have to change some of our behavior, some of our habits, and who we trade with, and all of that. And part of that is energy infrastructure, moving it more to an east-west basis, obviously, than a north-south basis, and other projects on top of that too. But Canada's going to be, you've seen a new level of agreement. I mean, provincial premiers and other things that just we're being forced into this corner by our friends, our former friends south of the border here. So.
And it looks like Pembina, fairly regular dividend increaser. 71 cents was the declaration in May, up from 69 cents.
And the die was cast a while ago when you worried about Enbridge cutting the dividend, when basically their dividend was exceeding their annual earnings and cash flow, and they continued to pay it. So I really don't worry about dividend payments from the pipeline companies.
John, thank you very much.
All right, appreciate it. Thanks, Andy.
John Zechner. So we're out of time on a market call. Let's have a very quick look at the markets before we go, because the TSX was in record territory. Now turning down. So we're not there right now. Let me just check to see what might be pulling us down. It was earlier at on course for an all-time high. Not seeing anything marked. Bank of Montreal, Royal Bank have slipped a bit today. Celestica. So they're helping to drag down the market. Thanks very much for watching Market Call. Brian Madden's up